Bitcoin just hit a weekly RSI of 25.6. That is not a typo. That is the most oversold reading in the entire 17-year history of this asset. And every mainstream financial headline right now is pointing to the same conclusion. Institutional money is abandoning Bitcoin. They will cite $4.5 billion in net outflows from US spot Bitcoin ETFs since January. They will tell you that BlackRock's IBIT has shed $2.1 billion in 5 weeks. They will show you a fear and greed index at levels so low that they've only appeared a handful of times in crypto's history. The story writes itself. Wall Street came, Wall Street saw, and now Wall Street is leaving. Except on February 26th, while those outflow headlines were still printing, blockchain trackers flagged something that completely shattered that narrative. BlackRock executed a $289.6 million spot Bitcoin purchase in under 1 hour. The very same week IBIT was making outflow headlines, the on-chain data showed 4,309 Bitcoin moving from Coinbase Prime directly into IBIT custody wallets in a series of coordinated transfers spaced minutes apart. So either the biggest asset manager on the planet has no idea what its own fund is doing, or the story you're being told about institutional abandonment is dangerously incomplete. My name is Lewis, and you're watching The Coin Bureau. So, is BlackRock genuinely playing both sides of the Bitcoin market? Is the ETF outflow data a misleading signal that is actively engineering panic among retail investors? Or is there a structural explanation for this divergence that most headlines are completely missing? That is exactly what we're going to be diving into today. First things first though, let's look at the data that has the retail market absolutely terrified right now. Since the start of 2026, US spot Bitcoin ETFs have logged nearly $4.5 billion in cumulative net outflows. The 5-week outflow streak alone, the longest since February 2025, accounted for approximately $3.8 billion of that figure. BlackRock's IBIT led the bleed, shedding roughly $2.1 billion. Fidelity's FBTC saw over $954 million walk out the door. Meanwhile, Bitcoin's price has fallen 47.6% from its all-time high of $126,296 that it reached in October of 2025. And on February 6th, the Crypto Fear and Greed Index hit a reading of 5 out of 100. Yes, 5. To put that into context, the index bottomed at 6 during the FTX collapse. Sentiment right now is worse than what it was in the wake of one of crypto's most catastrophic institutional failures. Now, when algorithms see ETF outflows of this magnitude, they do exactly what they are programmed to do. They interpret the data as a signal that institutional demand is dead, and momentum traders pile in on the short side. Retail investors, watching their portfolios bleed red, capitulate into a market already gripped by maximum fear. And the machine feeds itself. The mainstream narrative is clean, simple, and emotionally compelling. Problem is that it is only looking at half the picture. But here is where the story turns. On February 26th, blockchain tracking platform Arkham Intelligence, first flagged by Look On Chain, tracked something that the ETF outflow headlines completely missed. In the space of approximately 1 hour, beginning around 5:45 p.m. UTC, BlackRock's IBIT wallet received 4,309 Bitcoin from Coinbase Prime. The transfers were structured as repeated blocks of roughly 300 BTC each, with 2 transactions occurring within the same minute and others spaced 3 to 4 minutes apart. Total value at execution, $289.6 million. This was not a rumor and it was not speculation. This was on-chain data, verifiable on the public ledger, traceable to wallet addresses Arkham has attributed to the iShares Bitcoin Trust. And then, the very next day, February 27th, the same day that IBIT recorded a $32.99 million outflow, which was its largest daily outflow during that specific late February episode, on-chain data showed approximately 2,563 BTC and 49,852 ETH moving in the other direction, from IBIT wallets back into Coinbase Prime. Total value of that transfer, well, approximately $270 million. Same week, same institution, one flow going in, one flow going out, and virtually nobody in the mainstream press connected the dots between them. Now, this is the point where you might be tempted to reach for the word manipulation, an understandable impulse. But that framing, as satisfying as it feels, is actually less interesting and less useful than understanding what is really going on here, because the truth is simultaneously more mundane and more consequential. But before we get into that, did you know that if you use Coinbase Advanced, you could actually trade with fees as low as 0%? This is built in right into the Coinbase app. No separate account, no extra download, just one click to unlock. And once you're in, maker fees can go as low as 0%. And if you're coming from another exchange, their VIP status match lets you upload proof of your trading volume and immediately unlock a lower fee tier for 60 days, so you don't have to start from zero. That sounds pretty good to me. But now let's get back to BlackRock. To understand what BlackRock is actually doing, you have to understand the plumbing that sits underneath the ETF system. Most retail investors have no idea this plumbing exists, and the firms that built it are not exactly rushing to explain it. Here is how Bitcoin ETFs work at the institutional level. BlackRock does not buy or sell Bitcoin directly from your brokerage account. Instead, a set of specially licensed firms called Authorized Participants, or APs, sit between the public market and the ETF itself. For IBIT, those APs include names like Jane Street, Virtue Americas, JP Morgan Securities, and Marex. These are the only entities on Earth allowed to create or redeem IBIT shares directly with BlackRock. When retail investors or smaller institutions sell their IBIT shares on the secondary market, those shares can pile up at a discount to the fund's actual Bitcoin value. An AP buys those discounted shares, bundles them into a redemption basket, and presents them to BlackRock in exchange for the underlying Bitcoin. Bitcoin moves from IBIT wallets to the AP. The AP takes that Bitcoin to Coinbase Prime. BlackRock records the day as an outflow. The headline reads, IBIT sees 32.99 million net outflow. Do you see what just happened? The headline is not wrong, but it's describing a mechanical, contractual settlement process, not a mass exit of institutional conviction. Now, layer on top of this the cash and carry basis trade, and the picture gets even more complex. For the last 2 years, a significant percentage of the capital sitting inside Bitcoin ETFs was never there because someone believed Bitcoin was going to go to the moon. It was there because the price difference between Bitcoin spot and Bitcoin futures on the CME was generating annualized yields as high as 15 to 30%. Here's how it works. An institution buys IBIT shares on the spot market and simultaneously shorts CME Bitcoin futures contracts at the higher futures price. The gap between those two prices is their risk-free profit. The ETF share is not a conviction bet. It's inventory in an arbitrage strategy. When CME futures premiums compress, when the spread narrows or inverts, the entire trade unwinds at once. The institution redeems its IBIT shares through an AP, closes its CME futures short, and the published ETF flow data shows this is a massive outflow from Bitcoin. Amber Data's forensic analysis found the correlation between basis compression and ETF outflows sits at 0.878. That is not a loose association, but a near mechanical relationship. And their research suggests that between 20 and 35% of all capital that flowed into Bitcoin ETFs was there for the basis trade, not directional Bitcoin exposure. And speaking of tracking these institutional mechanics before they hit the mainstream headlines, this is exactly why you need the Coin Bureau Telegram channel in your life. It is where we share the latest breaking news, provide deep dive alpha, and give you the most important market updates, all pinged directly to your device so you don't miss a thing. Whether it's on-chain whale movements, ETF flow data, or macro signals flashing before the broader market reacts, sign up today using the link down below or by scanning this QR code right over here. Okay, so we have established that the ETF outflows are a deeply misleading signal during periods of basis compression. But here is the harder question that the flow data is actually masking. Because while the basis trade mechanics explain the outflow headline, they do not explain who is accumulating the Bitcoin that leaves these ETF structures. And that is where the on-chain supply data tells a completely different story. Exchange reserves of Bitcoin have fallen to approximately 1.8 million BTC. According to BRN research head Timothy Meeser, that is the lowest level since 2017. Over 171,000 Bitcoin were withdrawn from major exchanges in just the weeks following the US election cycle in late 2025. Meanwhile, Glassnode confirms that long-term holder supply currently sits at roughly 14.4 million BTC, approximately 72.7% of all Bitcoin in circulation. These are coins that have not moved in over 155 days. And they are not moving now. Not into fear, not into panic, not anywhere. At the same time, crypto analytics firm Santiment flagged that wallets holding 100 BTC or more were approaching 20,000 in number. And market analyst Matty Greenspan confirmed that accumulator addresses have absorbed roughly 372,000 BTC since late December, a rate of accumulation historically associated with cycle bottoms, not cycle peaks. The most recent on-chain data showed Bitcoin whales net purchased approximately 270,000 BTC over the past month alone. At current prices, that is roughly $23 billion worth of Bitcoin quietly swept up while retail panic sold their ETF shares. That is the largest net whale purchase in over 13 years. Now, step back and hold both of those pictures simultaneously. On one side, ETF outflow headlines screaming institutional abandonment. On the other, on-chain accumulation data showing the largest whale buying event in over a decade. Those two things are not easily reconcilable if you assume the headlines tell the whole story. They are perfectly reconcilable, though, once you understand that the capital leaving through the ETF door is largely basis trade arbitrage unwinding, while an entirely different class of institutional money is entering through the OTC door, invisible to published flow data. Coinbase Prime processed hundreds of billions of dollars in institutional OTC volume in 2025. OTC trading volume surged 109% year over year in 2025, compared to just 9% growth on the top 20 centralized exchanges. None of that shows up in the ETF flow reports. All of it shows up on the blockchain, if you know where to look. Now, here is where the supply dynamics add the final piece. Bitcoin's weekly RSI has fallen to 25.6. Multiple independent sources have confirmed this reading, with Matty Greenspan calling it the lowest RSI reading in Bitcoin's recorded history. The only comparable weekly oversold episodes were November and December of 2018, when Bitcoin was crashing from $6,000 to $3,000, and June and July 2022, during the Three Arrows capital collapse. In both of those cases, the extreme oversold reading preceded the final capitulation flush before a structural recovery. In 2020, after the COVID crash sent Bitcoin to $3,850 and the Fear and Greed Index hit single digits, the asset recovered its pre-crash level in approximately 75 days and closed the year up nearly 300%. Now, the current drawdown does have a critical structural difference from June 2022, which is worth being precise about. In 2022, the collapse was accompanied by systemic contagion, the implosion of Terra Luna, the bankruptcy of Celsius, Three Arrows Capital, FTX. One failure triggered the next. Bitcoin fell 77.6% over 12 months and took 24 months to reach a new all-time high. Bernstein Research has explicitly noted that the current 2026 drawdown lacks those defining contagion features. No major exchange collapse, no algorithmic stablecoin implosions, ETF infrastructure fully intact at $84.8 billion in total AUM across the complex. The 200-week moving average, which has marked the absolute bear market floor in 2015, 2018, and 2022, currently sits at $57,926. Bitcoin has not breached it. In 2022, Bitcoin fell below that line in June and did not reclaim it for 16 months. The fact that the 200 WMA is holding as support, combined with the most extreme weekly RSI in history and whale accumulation at 13-year highs, is precisely the setup that Wall Street's institutional desks spend years waiting to position into.
What's the verdict?
Well, to be blunt, the ETF outflow headlines are lying to you by omission. Yes, the outflows are real. Yes, 3.8 billion leaving the ETF complex in 5 weeks is historically significant. But the structural driver of those outflows, confirmed by Amber Data's correlation analysis, by CME open interest data, and by Bloomberg's own ETF analysts, is the mechanical unwinding of basis trade arbitrage positions, not the mass exit of long-term believers abandoning Bitcoin's thesis. The 289.6 million spot Bitcoin purchase on February 26th was real, as were the 270 million in on-chain transfers between IBIT wallets and Coinbase Prime. And critically, these movements represent the operational settlement mechanics of the IBIT trust, Bitcoin flowing between custodial infrastructure in direct response to creation and redemption activity, not some clandestine corporate accumulation BlackRock is running with its own proprietary capital. The intellectual honesty here matters. BlackRock is a fiduciary acting on client orders, not a single entity actor secretly loading its own balance sheet. But here is what is happening, and it is arguably more significant. The entities who actually built positions into their fear are the ones that 13F filings have confirmed. Sovereign wealth funds like Abu Dhabi's Mabudala increased their IBIT exposure during the Q4 2025 drawdown. Approximately 1,690 institutional entities collectively hold IBIT shares, names including Millennium, Jane Street, Citadel, and multiple sovereign-linked capital pools. And on-chain, whale wallets have absorbed 270,000 Bitcoin in the past month alone. Short-term holders, largely retail and leveraged, have been realizing losses at nearly $500 million per day. Glassnode confirmed this is a full transition into excess loss realization regime, language last used during FTX-era capitulation. That capital is not disappearing. It is transferring. The institutional adoption of Bitcoin was never going to be a straight line up. It was always going to involve cycles of engineered-looking volatility. Whether that engineering is intentional or just the mechanical product of basis trade unwinds and AP redemptions is ultimately less important than the outcome. The outcome is that patient capital is accumulating, while impatient capital exits at a loss. BlackRock is not playing some villainous double game. But the ETF system they built and the derivatives infrastructure that sits underneath of it does create a structure where outflow headlines consistently overstate institutional retreat during exactly the periods when different classes of institutional money are most aggressively accumulating. That asymmetry of information is not an accident, and retail investors who read only the headlines are bearing the cost of it. But what do you think? Is BlackRock's ETF infrastructure genuinely distorting the retail perception of institutional demand? Or is this just the inevitable complexity of a maturing asset class with multiple competing capital pools? Let me know your thoughts in the comments below. And if you want to understand the exact mechanics of how the CME basis trade has reshaped Bitcoin's price discovery, well, you could check out our deep dive of that right over here. And if you want to see why the traditional safe haven narrative is currently failing its biggest geopolitical test, well, we have a video on that right over here. Okay, thank you all so much for watching, and I'll see you again very soon. This is Lewis, signing off.